So we've seen the data around how the S&P 500 has performed during recessionary periods between 1953 and 2020. But what lessons does that give us in regards to how we can actually plan for a possible recession in 2023 and 2024? With all this talk of a possible recession in 2023 and 2024, I think that there's a really big question that isn't being answered right now, and I'm going to attempt to do so in this video. That question is, how do stocks perform during a recession? More specifically, before, during, and after. I think we're in a really difficult position right now where we've got soaring inflation, we've got interest rates rising, we've got energy prices, food prices. It feels as though we're being hit by all sides. So before we get into the video, here's a little message from our sponsors that hopefully will put some more money in your pocket. And that brings us on to our sponsors, Wealthify. Wealthify is on a mission to make investing easy and affordable for everyone. They're challenging people to think differently and do more with their savings. Their promise is pretty simple: no complicated jargon, no daunting fees, just straightforward, effortless investing. Now, Wealthify are currently offering up to £200 cash back if you transfer an ISA or a pension to them, or up to £400 if you transfer both. Terms and conditions do apply. There is a link in the comments below, but essentially you've got to register your interest for this by May 1st, 2022. You're going to have 6 months to complete your transfer. Not only that, but if you invest with Wealthify before June 1st, 2022, you'll be entered into a prize draw to win £20,000, which is essentially your ISA allowance. Now, entries for this close June 1st, 2022. There is another link pinned below which will give you information on how you can enter. Terms and conditions apply both for the cashback and the prize draw. Unfortunately, if you're a resident in Northern Ireland, the prize draw excludes you. When you invest, your capital is at risk, so please remember this: you could get back less than you put in. Wealthify is authorized and regulated by the Financial Conduct Authority. If you do enter, please let me know. I've got my fingers crossed for you. I hope that you win. A recession is a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in 2 consecutive quarters. Now, we're not currently in that environment, certainly not here in the UK at the moment. If you have a look at data, the economy grew by 0.1% in February, and that is after a 0.8% growth in January. Now, obviously, we've got soaring inflation, ridiculous cost of living crisis at the moment, so those numbers may change moving forward. But at the moment, we're not in a recessionary period. Now, in answering this question, I think it's really important for us to have a look at what's happened historically. And let's have a look at a chart which takes us all the way back to 1953. Now, this chart right here is a chart looking at the performance of the S&P 500 specifically, and it's looking back between 1953 and 2020. So during that time, we've had about 11 recessionary periods. And this is highlighting the performance of the S&P 500 during a recession, 6 months before, 12 months before, 6 months after, 12 months after, and 2 years after the recession. Now, notably, what I can see here and what sticks out to me is we have mixed results across the time period when we look at the performance during a recession. In 1953, 18%. In 1960, 17%. Those are the highest that we can see on record. The one that jumps out to me, though, is the one back in 2007. And this one I do remember. We saw the S&P 500 reduce in value by 37%. It's quite a significant drop, and it's the biggest one on record thus far. Even if we go to 2020, where, this was as a result of pandemic lockdowns globally, we only saw a 1% decrease in the S&P 500, which is very, very interesting because the recession that we're likely to face moving forward in 2023 or 2024, according to a lot of the analysts, are essentially because of hangovers, supply chain issues, so on and so forth, all the quantitative easing that happened during the pandemic. But there were necessary measures to keep GDP, economies afloat at the time. Now, if you look at these periods, I'm going to pay attention to 2007 specifically, right? Because I think that is the most recent one that we can really kind of like latch onto. Now, 6 months before the recession actually began, we saw back in 2007 that the market was actually slowing. We saw minus 2% performance here. Now, 12 months before, we were up 4%. So we saw that the markets kind of took back its returns, its profits in the previous 12 months in that 6 month period. But it's interesting to know that 6 months after that recession actually began, the markets were up 21%. And if you look back over history, going back up to 1953, we can see that 6 months after the recession, 70% up. In 57, 18%. In 60, 7%. In 69, 14%. There were only a couple of years where we saw that the markets were down 6 months after the recession. 19% in 1981 and 6% in 2001. Even in 2020, we saw the market go up by 12%. If you average out the performance 6 months after those recessionary periods began, dating back to 1953, 6 months after the recessions began, the markets on average have been up 7%. You look at that now and you step back and have a look at 12 months, average performance is 16%. Again, 2020 is a really, really big kicker here. We're seeing 44% increase in 2020, 12 months after the recession began. And I think we've all benefited from that if you've been invested in the markets over the last 12 to 18 months specifically. But go back to 1953, 30%, 1957, 33%. Even in 1973, 23%. We've only have 1 year where we have a negative return 12 months after the recession began, which is in 2001 of minus 18%. You step back out again and you have a look at what happened 2 years after. Well, in 53, 55% up. We have a couple of negatives here. In 1980, minus 12%. In 2001, minus 7%. In 2007, the market was up 44% after the recession began. And as you can see here, on average, over that period of time between 53 and 2020, on average, the market has been up 20%. 2 years after the recession began, 16%, 12 months after the recession began. Now, these numbers are really, really interesting because even when you go and have a look at the performance of the market 6 months before and 12 months before, and this is one that I think is very, very interesting. So 6 months before, and this is the S&P 500 again, right? The S&P 500 was down 2% 6 months before the recession started. 12 months before, it was down 3%. If you look at the S&P 500, as of the time of recording this video, we're almost approaching a minus 3% performance in the S&P 500. Now, does that foreshadow the recession? Only time will tell. Who knows? But I think these numbers are very, very interesting in giving us an insight into the past for us to kind of gauge and understand, or at least form an opinion of what we might expect if we do go into a recession in 2023 or in 2024, depending on obviously the levers that the Fed and all of these things that need to happen in the background, really, that could cause this recession in the first place. So we've seen the data around how the S&P 500 has performed during recessionary periods between 1953 and 2020. But what lessons does that give us in regards to how we can actually plan for a possible recession in 2023 and 2024? Well, for me, the first thing that pops to mind is this saying by Warren Buffett: be fearful when others are greedy and greedy when others are fearful. And if that statement is true, we have a pretty good indication of people being fearful right now in the fact that 81% of US adults are worried about a recession hitting this year. But what does that actually mean if you're investing as a first-time investor? Well, pound cost averaging could be really beneficial. Pound cost averaging can be quite powerful. It's simply investing into the market on a regular basis. That might be monthly, bi-monthly, it could be quarterly. But the idea is that you're buying into the market at different price points. And over the long term, that could really help you iron out the volatility that you're going to see in the markets, particularly if the markets were to fall. Now, it's really important to go back to the numbers actually, because I think during a recessionary period, and we saw this in the chart, and this is the chart here again, in 2007, we saw that 6 months after the recession began, the markets were up 21%. In 2020, that number was 12%. And yes, there are some negative numbers in the 11 recessionary periods that we have seen so far, and this is no indication to future performance. Your capital is always going to be at risk. But according to this, 6 months after recession begins, we tend to see a bit of a market bump. Now, that doesn't negate the fact that if you did have funds invested in the stock market before the recession hit, you're probably still going to take a hit on that pot of money. But any new money that you're paying in on a monthly basis has the chance to get a bounce because you're buying in at a low. The second thing for me, and this is something that I talk about all the time here on the channel, it's important for you to be clear on why you're investing and your investment strategy. You need to have faith in that investment strategy. The reality is that if you're investing for the long term, a recessionary period means absolutely nothing. There is opportunity in recessions. There is opportunity in market volatility. It means that you're going to take a hit potentially on the amount of money that you've got invested in the markets already. But if the numbers are anything to go by, we know that there is a bounce after recessionary periods. In fact, this is another graph right here, which basically just highlights to you the effect of the market bounce during periods of, I guess, fear, where people are worried about the markets. And this goes back to Black Monday, the Gulf War, the Asian monetary crisis, the tech bubble, the financial crisis back in 2007, the trade war in 2018, and the COVID sell-off in 2020. As you can see there, the yellow bars in the next 12 months really demonstrate that the markets bounce back. So having confidence in your investment approach and your strategy and why you're investing is really, really important. The third one is probably the most, I guess, obvious one of all. Hold your nerve. Yes, it is easy to panic. It is easy to look at your investment portfolio whilst you're down and it's in the red and you want to protect yourself. That is a human reaction. We all have that innate reaction within us. But I will say what I've always said on this channel: a loss is not a loss until you've cashed it in. The same thing applies to a gain, but particularly because we're talking about a recession here, even if you do see your holdings down 5%, 10% during the recession, just remember, it is not real till you cash it in. It is literally just a number on a phone that is an indication of the money you would get back if you cashed in your investment. Holding your nerve is so important. Let me know what you think of this video in the comments. Are you expecting a recession in 2023, 2024?